Okay, let's have a look at Skechers. Who knows Skechers? Who heard about Skechers before? All right, great. I've never seen them myself, so I don't know this company. Probably, as I said, maybe I even was using them, their shoes, but I actually never paid attention. Now, let's have a look at their value line report. Straight away, what I want to point out, look at their price earning ratio, 11, and Nike was 22. So it means that the the price compared to earnings in Nike, people happy to pay 22 times of their earnings. And if assuming that the company will keep making the same amount of money year after year, it will take them 22 years to get their money back. Like if we take that they as a shareholder own that company, whereas with Skechers it's only 11 years. So it's half of the time which you need to invest and wait in Nokia or in Nike. Okay, so this multiple is much lower than Nike. That's one point. Look at this volatility. If we saw Nike, it was steadily growing all the time. With Skechers, it's not the case, and we can see it was moving up. For example, here it was $12 before the GFC, and then look at this, it went to $3. So it's lost 75% of its price, like at this particular moment. And we'll have a look now what was the reason. Similar story here, it was $15 before 2011, and it went to $4. Again, about 75% loss in their price. So imagine if you bought for $100,000, that would be worth about $25,000 here. So it's kind of huge loss. Not many people can handle when something like that happens. Okay, but the good thing about if we look at value line expects the price from current levels. Actually, the level is 22, so it's moved up nearly 10% since the report. They expect 30% growth every year. So altogether, they believe that within the next 3 to 5 years, company would be somewhere in between $35 and $55. So it's what will represent the growth from 85 to 190% in total. So if you invest $1 million, it's going to be $1.10 million in 3 to 5 years. So maybe it would be $2.9 billion if it's on the highest level of growth. Okay, that's what value line expects from this share. Okay, let's have a look at sales level, and we try to understand how crisis GFC affected this company. So we can see it was 835, so it's a drop here, then 7 again drop here, then growth, then growth, then growth, then growth, growth, kind of drop here in 2008, then growth again, then drop again, then drop again, then growth, 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 growth. Okay, so for the last several years they're growing in sales, but before we can see it wasn't that stable. Okay, of course it was much smaller company at that stage, and but still for us it's important to see the pattern. Earnings, 40 cents, 41 cents, 40 cents, so flat, and then negative deficit of 10 cents. Then profit, growth, kind of flat here, then drop again. And the drop here is quite huge. Remember that when we looked at Nike, they didn't have this loss at all. Their earnings were growing. Even in 1 year, they had a lower sales level, 2 cents, something like very small. Whereas here, it's practically 80% lower earnings. It was 60 and here 30. Okay, not exactly 50%, but about 40% drop in revenue. And then it started growing. Then in 2011, we can see from 93 cents profit, it went to 35 cents loss. And since that moment, it's kind of steadily growing. Okay, and last year it was the max. Okay, and the price last year was $54. Okay, and now it's only $20. So it's kind of fell quite a lot. What, more than 50%, about 60% drop in price. If Nike dropped in price only about 25%, we looked at this. Here we can see that the drop is much lower, about 60%. Okay, so dividends, it doesn't pay any dividends. So if you're a dividend investor, you don't like that, but we're going to have a look at the rate of return on their capital. That's important. Book value. Look at this. Book value is higher than in Nike. Nike had book value around $6 or $7. Here it's 8.6, $10. Now, of course, you have to have a look here, tangible book value. So please, if you decide to investigate it deeper, go to their financial report, balance sheet, and see if it is just tangible book value or there is something included intangible here. Okay, so it's important for us. And we can see that book value was growing generally, so it's pretty good for us as well. Then we can see that common shares outstanding, that we can see that amount of outstanding shares is actually growing. So it's become more and more. So they issue more shares. I didn't pay attention to Nokia, but I think in Nokia it's vice versa. Amount of shares is dropping down, so it's becoming less. Now, price earning ratio. If we look at price earning ratio, Skechers, they had price earning ratio similar to what Nike has now, 22, 23, okay, for the last 3 years. Before it was pretty low, it was 12, 10, 16, 15, so much lower than for the last 3 years. But why people were happy to pay higher price? Because the share were growing. Now the share dropped down, and look at this. It's not only falling in price because their profit going down, but actually because the PE ratio reduced. So if last year people were happy to pay 22 times more for the share compared with their earnings. Now they're happy to pay only 11 times. So of course, even if the share makes same amount of money, the price has to drop 2 times. Simple as that. And nothing changed between these two shares within last whatever 6 months. Okay, so in terms of value as a company. Okay, it's otherwise they expect the growth, but the growth is not as big. That's where people were happy to overpay. Look at this, from 6 cents to 36 cents. 6 times growth here, from 36 cents to 90. So it's about what? Not 300%, but maybe 250% growth. Here from 90% to $1.50. So it's again quite huge, about 60, 70% growth. And this year it's only 10% growth. That's why, because the growth rate slowed down, and because the company has this historical fluctuations, people start selling the shares straight away. Okay, in this particular case, so you understand that. Okay, now if we look at the sales as general in company, we'll see a similar type of pattern. Was 2 billion here, 1.6 billion here, 1.5 billion here, then 1.8 billion, 2.3 billion, 3 billion, 3.5. So the sales, they're growing within the last few years, so which is good. Gross margin is very high, but when we look at net profit margin, it's 7.2 and 8.1 they're planning. And here was 3% of net profit margin. If you remember the level of Nike, it was above 10. So higher, right? So Nike can make more money because of its brand than Nike, or than Skechers, sorry. Okay, so that's a good kind of theme about Nike. So the branded name, it's generate higher revenue for them. Okay, number of stores, we can see that number of stores is constantly growing. It is a good thing, so it means they're expanding. And if sometimes they come back to the same type of rate of return, so we can expect a fast growth in earnings as well. So the good one. Long-term debt. The debt in Skechers, look at this, is pretty low. So if we look, okay, we'll come back to this type of, but look at long-term debt, it's 65 million only, right? And if we look at net profit, 255 million or 230 million last year, and they have only 68 million or 70 million in debt, it means that what? They need to work about 3 months in order to pay off their debt completely. So from debt perspective, they're even stronger than Nike. They have less debt compared to their earnings kind of level. Okay, so that's a good thing. Let's continue. Okay, capital structure. So that's the debt, 74 million, and it's 3 billion capitalization company. So it's actually what? Quite low level, really low level of debt compared to capitalization. Then if we're going to look at return on share equity, we can see it's 16%. And remember, Nike had 30. So Nike has higher rate of return on capital employed. So it means that if you company invest, if you deciding where to put your money. So here it gets 17% return on the capital which they're receiving, the company, and Nike had 30% return. So which is much better from that perspective. But Nike is not as undervalued as Skechers. We already look at pricing levels, but in any way, so we're going to look at this more details now. Growth rate. Let's have a look at growth rate. For the last 10 years, we can see that sales in general were growing about 7%. Last year, here at 7.5. Last 5 years, 7%. So if you remember in Nike, the last 5 years growth was higher. It had 10 and then it was 11. Here it was 7.5 and 7. So it's actually slowed down. Then if we look at earnings, they had 20% growth within average if you take 10 years and 11% within last 5 years. So the growth rate slowed down, but still it's much higher than in Nike. But if we look at the future, look at them. They're planning to have sales level growth 14% and 25% in their earnings, which is pretty impressive. Okay, but always say, okay, how can they be right? Are they right? 25%, is it sustainable? Can we trust these guys? Always goes where? After that, in order to check it, go to the right corner of the value line. Look at this earnings predictability, 15%. And remember what Nike had? 100%. So it means that Skechers, they only right every 6th time when they are promising something. If they are telling that 100 times they promise something, only 15 times they're right. Okay, in their earnings. So they kind of cannot tell you for 100% how much they're going to make. So that's why I am going to be less confident with these numbers than with Nike. Okay, so that's a huge difference. And then look, book value, they expecting to grow 22%. Still, numbers are pretty impressive from that point of view. Okay, now we analyzed this company, and here directors, I think All Insider owns 61% of B shares and 12% of A shares. So quite a lot of shareholding capital as well. So and that's good for us. We expect it. Okay, so what do you think about this company? What's your opinion? Yeah, not solid as Nike, but still, if you compare with different companies, it's pretty solid. But we'll have a look now what kind of younger version of Nike, I would say. So it gives Jan, you actually hit the ball. It's more risky, but at the same time, it has a higher rate of return, potential to growth. So you can make more money, but maybe you can lose more money. Okay, so you understand that, yeah? So it's always have to consider risk-reward ratio. Now, actually, another point which I wanted to make is similar to Nike. Remember now their second quarter in Nike, right? It was ending up in 30th of November. Now we don't have this 30th of November, but we have December. And if you look at December quarter, we can see that it's also the lowest. So it was 18 cents and then drop to 9 cents. and then was growing. Then it was from 33 cents to 15 cents, and then again growing. And then from 43 to 19, and then from 42 they are planning to have 12. So similar type of pattern. So it means that this particular quarter, which we are right now, after kids going to school, it's not that good quarter. Okay, for whatever reason, probably parents spend all the money in summer when they preparing kids for school and maybe buy everything, because previous quarter is pretty impressive and good, and after that, that's it. It's already not as good. Okay, so very similar pattern. So I presume if the financially ends 31st of December, we can expect earnings sometime in end of January or early February. But I have it written. We'll have a look at this in few seconds. Okay, so that's Skechers. That's if we use this Excel table, we get 36 points. And you could make this assumption yourself, right? So when you looked at this company, you already knew that it wasn't as good as Nike. That's why Nike had a higher score rather than Skechers. But again, it's always pay attention where it's losing its points. Now, first, it's losing industry rank. So it gets 2 points out of 4. And industry, remember, in each industry, even though the whole industry is going down, some companies within that industry might go up. Okay, so it's not exact 100% like we have to pay attention. We have to consider it, but still, right? So we remember that Skechers and Nike, they're best companies in this particular industry. The next, so we lost 2 points here. We could have 4 instead of 2. Timeliness. We got only 2 here out of 8. So we lost 6 points here. And timeliness, it's again rank, which is given by value line. Okay, and of course, the guy who analyzes this company, he knows this company probably much better than we do, but still, that's their opinion. Okay, and by analyzing our company, we can see that it's pretty low right now, but they believe that within the next 12 months, it's the growth would be less than other companies. Safety, we lost a bit on safety, 2.5 safety rank, but remember that they have very low debt and pretty stable company in any way. So debt level, best points here, and on beta as well, we lost some on beta. And on the growth trend, we don't have the stable growth trend because we have only growth within the last 3 years, and before we had a fluctuation. So that's why we got only 9, not highest, and that's why we got in total 36. Okay, so we know where it's losing, and if you consider this company as an investment vehicle, always have to calculate your risks. Okay, and if you can bear it, so you can go ahead and do it. If you think that it's too risky for you, stay away from that. Now, if we analyze price analysis of Skechers, so that's what we can see. I didn't put this year because it was negative. And actually, I even was considering not to put this year because the earnings probably half of a year were loss, and then they were making money, so it's only 6 cents at that point. And if we take into account this year, which might confuse our calculations, so our average high PE, it was 33. It's actually very similar to Nike. Nike had about 31, something like that, highest level PE, right? So very common for this industry. And then average low is 12.90, so it's about 13. And at the moment is 11. Okay, so price earning ratio now it's much lower. It's at a lower level than it's historically for the last 5 years. So it's a good point for us. Like it means that we are selling, they are selling on a bargain. Now, if you take these numbers and calculate the highest point and the lowest point, we can see that lowest stock price, it's about $19. And at the moment, the price is about 21. I think we're just going to check the chart. And then highest buying price is 44. So even from 19 to 44, you have 100% growth potential. But then it has a hold period, which is up to 70. So from 20 to 70, it's 2 point time ties. and then we consider to sell after $70 level. So if we try to see our risk and rewards, so when I was putting this form, it was $22.45 a share. It means that the risk of going down to 19 is only $3. So it can go down $3 based on our analysis here, but it has potential to go $71 up. So again, it's 23 times higher reward than the risk. So that's why in our case, we get the highest points here for risk reward ratio. And when you consider this growth, you can see how much money you can make. Okay, in this case. Now, when you're dividing your portfolio, and if you decide to, okay, where should I allocate my money, Nike or Skechers, you like Nike because it's quality, but you like Skechers because it has higher potential, you can split your portfolio. Okay, for example, if you always for good quality stock you allocate, assuming like $15,000 out of your portfolio, maybe for this type of companies you will put only half of it, or maybe third of it. So instead of 15,000, you put only 7,500 or maybe $5,000. Okay, so it has higher return potentially, but it has higher risk. So you reduce the amount of money which you invest in this type of companies. That's kind of what you can do to protect yourself.